Hi, I'm Rob.
And I'm Rob.
And this is Ask Rob and Rob.
Welcome to Ask Rob and Rob. It's a Tuesday. That means it's Ask Rob and Rob Day. That means two intrepid listeners have called in with their questions and we're about to give them the best answers we possibly can. We've got questions coming up from Cameron and Arun today. But before we hear those questions, what about your question? How do you send it over to us? Rob, let them know.
Well, we haven't changed the format for 2022. It's really simple. You can go to propertyhub.net/ask and leave us a message there. You can re-record it if you mess it up. No pressure. Just get your question in. Or, likewise, on the telephone, you can leave a voicemail. Leave as many as you want till you get it right. It's 013-808-00035. Super simple. And that's the format that Cameron has followed.
Hi, Rob and Rob. It's Cameron here with a question about mortgages. Before I do ask that, I just want to thank you very much for a wonderful podcast that I found very helpful and inspiring. As you can probably tell from my accent, I'm South African and I've only been in the UK for about 3 years, which means I've got another 2 to go until I can get permanent residence. As a result of this, I've found that lenders are very reluctant to lend to me, and the mortgage broker I've spoken to has said that the options are pretty limited at this point and will be until I have permanent residence. I've got the funds to invest and I'm looking at Nottingham city centre, looking for a flat there. It's good quality. Well, I'd be looking for good quality flats in the area, targeting capital growth. The one lender who is able to lend to me has given me a pretty average interest rate of 7.7%. That's on an interest-only mortgage, which means that the property probably won't have positive cash flow. I was just wondering if you would still invest in this situation, given that I'll be banking on capital growth anyway, and I know the market's quite hot, and from your latest sort of podcasts, I'm getting the feeling that it's probably still worth it and I don't want to miss out. But welcome any thoughts you have on that though. And thanks again.
Thanks, Cameron. It's going to be interesting. I wonder what Rob D will say on this, but my opinion is I wouldn't invest. And that goes against what you thought we were going to say. But the reason I wouldn't invest, because if you're going to make a cash flow loss on your property each and every month, in my mind, it's not an asset. It's actually a liability because it's costing you money to hold it. So, yes, we expect Nottingham to do well from a capital growth perspective this year. And yes, we think long-term it should do well. But just because we think it should doesn't mean it will. And you can't gamble on capital growth alone. You must make sure that the investment in its own right stacks up and covers its costs and hopefully makes a little bit of money too. Now, you don't need to go for the highest yielding properties because you are hoping that you've picked an area of high capital growth instead. But to just solely rely on capital growth, in my mind, is a mistake. Because while you may expect an increase in prices over the coming years, at some point, it won't increase. And at some points in the cycle, it will decrease in value. And then all you've got is an asset going down in price that is costing you money to hold, which isn't a great scenario. Now, over the coming years, there are going to be a lot of people in your situation who want to invest and may be willing to accept properties that don't make money and just rely on capital growth. But I think they are properties you should avoid. I think you should check with another mortgage broker, get a second opinion, see if you can get a better rate, and then go forward if you can make it stack up. But if you can't, I would continue to look for something else that does, or wait until you can get a better product. But Rob, you may feel differently, because I know you're a big Nottingham fan, so do you want to correct me?
Well, maybe I'm being biased by the Nottingham angle, but I don't think it would be crazy to invest. I think there are some properties where it's like, by nature of the property, the area, the type of investment, whatever, it's just never going to make a rental return. So you're always going to be relying/gambling on the capital growth. In this case, it's the mortgage rate, and the mortgage rate is high because of Cameron's circumstances. So any property pretty much is going to be in that position. So then it's like, well, do you just not buy anything for 2 years? Maybe. But then I'd say it depends on like how certain you are that you're going to be able to get better rates in 2 years' time. If you are pretty damn certain that you will be able to get far, far, far more competitive rates by the time you have your residency, then you can say, all right, well, I'll kind of deal with this for a couple of years. I'm anticipating capital growth in those 2 years, so I don't want to miss out on it. So therefore, I will just deal with it and then refinance in a couple of years and be in a far better position. So I don't think it would be a crazy thing to do. However, that doesn't mean that you have to. And you are, of course, in a far more vulnerable position having a property that is losing money. So I think it also depends on the strength of your finances in general and how well you'd be able to weather that. So I'm certainly not disagreeing with you, Rob. I think what you said is exactly right. But I don't think it's as cut and dried as it is in some circumstances with this one.
Well, who would have thought in 2022 I become the more cautious one? It's a crazy world out there. Okay, let's see if we're aligned on our answers for the next question, which comes in from Arun.
Hey Rob and Rob, it's Arun here. Just before I kick off, just want to say a massive thank you for all the time and effort that must go into putting these podcasts together. I've been listening for just over a year now, and I can say that I've learned so much more through you guys than I have done from any of the paid property courses that I've been on, which is insane. But anyway, my question kind of relates to the 18-year property cycle in a way. So my mortgage term on my home is due for renewal in 2025. Now, if the cycle is correct, which it may not be, but if it is, and the market continues to boom until that point, I'm wondering whether it would be a good idea or not to refinance at that point in 2025, maybe back to a 90% loan to value, chucking it on another 5-year fixed at that point. And essentially is keeping that money aside in preparation for what the cycle suggests might be another crash that happens, in the years that follow that. But yeah, just keen to hear your thoughts on, refinancing just before you think there's going to be a crash. Is the risk of negative equity such a bad thing if I'm locked into a 5-year deal? But yeah, keen to hear your thoughts. Cheers, guys.
Okay, thank you for your question. And I could answer your question very quickly by linking you to a podcast episode, and then I'll give you a bit of an actual answer as well. But back in July last year, episode 434 of the Property Podcast, we had an episode with a mortgage broker called How to Use Leverage in a Boom and a Crash, which exactly addresses the very point that you're asking. So you should absolutely go and listen to that next before you do anything else, because it's like we recorded it specifically for you. But to give you a quick answer now, I think what you said is about right. You're thinking along the right lines. 2025 is a good time for your mortgage product to be coming to an end, because if the cycle plays out as we anticipate it to, then that is going to be getting to the most heated part of the cycle, which would be potentially a great time to lock in a competitive rate when lenders are very keen to be lending you money and will probably do so at far better rates than they will do for the few years following that. So you can get that locked in and potentially pull out equity for some of the growth you've had in the meantime. That is something that very much divides investors. Some people want to get the money while they can, so they're in a position to go and hoover up some bargains on the other side. Others would rather pay down their debt. And that's a complex answer. It's partly about psychology. It's partly about your financial position in general. So I can't give you an answer to that. That comes down to you. But that is the basic outline. And for a fuller answer, including an answer to your point on negative equity, do go and listen to that episode, because I think you'll get a lot out of it.
No disagreements on that one. Don't listen to that episode. That's what you need to do. And what you also need to do is join us next Tuesday for Ask Rob and Rob, because we've got loads of questions in the virtual mailbag to answer. So we'll be back answering them then. And of course, you've got the Property Podcast to keep you more than entertained in between. So until then, take care, have fun. Bye-bye.
Bye-bye.